Hi everyone, I'm Nicholas with Hope and Numbers Media, and today we're going to be doing a book review on investing for dummies. And so we're going to start off with the first book out of the 8-book all-in-one inclusive, and it's called Getting Started with Investing. It's only 3 chapters, and it's by Eric Tyson. So for each of the chapters, I'm just going to be reviewing the main key points. Chapter 1 is titled Exploring Your Investment Choices. So the first point is understanding your limitations and when you should seek help. It is easier to invest in research in the US or your domestic market than in foreign markets. So when you invest outside of the US, you should really seek some financial advice, maybe go talk to a money manager. The second point is make ownership investments. Ownership investments are purchasing an interest in a company or asset like stocks, real estate, or a business, all of which can create revenue and profits. Point 3 is you don't always need to make your money grow. This is pretty important, especially if you're someone who gets anxious or stressed out and doesn't like to take on risk. If you're making a steady living, budgeting, saving, and being smart, then you might not want to take on larger risks. In this instance, you may be better off paying off your mortgage or something less risky. Point 4, creating leverage with real estate. Leverage is when you borrow money to make a return. An example of this is taking out a loan to purchase rental properties. Many other ways exist to utilize leverage. Point 5 is growing money faster than inflation and taxes require you to take on risk. Whenever you try to grow your money, you are risking that you will lose the money you already have. Point 6, making money by lending your money. There are many ways to lend your money. Commonly, you could place your money in a checking or a savings account or even a certificate of deposit, which is a CD, where generally you agree to certain chunks of time. You can also place your money in a bond for a particular rate of interest over X amount of time. Point 7, the problem of taxes and inflation. By lending your money, especially to banks, you will not receive a high enough return to beat taxes and inflation. Generally, the value of your money becomes less each year when you lend it to a bank. This erodes your purchasing power, which is not good. Point 8, consider cash equivalents. Cash equivalents are investments that you can quickly change to cash. An example of this is a money market fund. You can usually write a check from one or even do electronic transfer. There are also a lot of tax-free money market funds, which is really important for those of you who are in a higher tax bracket. Point 9, educate yourself before finding a financial advisor and be skeptical. Many advisors work solely on commission or other fees, which is a conflict of interest. The more money you give them, the larger their cut will be. So, they're incentivized to have you invest more, even if it's not in your best interest, because it's in their best interest. Therefore, it's recommended for you to find one who charges only on an hourly basis, charges on nothing else. Do your homework. Look up their track record with the SEC and ask them to send you their ADV form, which is a uniform application for investment advisor registration. Moving on to chapter 2, we have weighing risks and returns. So the first point is keep a diversified portfolio. You've probably heard this a lot, but it goes more than just picking more than just a single stock. You see, your stocks shouldn't only be in the U.S. market, especially if you're worried about the economy and government, etc. Diversify internationally and preferably by ETFs or mutual funds instead of single stocks. Also, consider diversifying into other markets like real estate to lower risk. Point 2, understand how long you'd like to be invested for. In every 3 years, stocks and bond markets lose value, meaning that their profitability is approximately 2 out of 3 of the time each year. The amount of time you'd like to hold an investment will influence what you should be investing in. In long term, stocks are less volatile than bonds, but in short term, they are much more. Point 3, minimize losing money in the stock market by keeping your portfolio for longer periods of time. So the stats right here is based off of U.S. stocks average annual returns for different holding periods based on the S&P 500 index, which is a large cap index. So the first year, you're going to see a high of 61.2%, an average of 33.3%, and a low of negative 29.6%. This is if you hold your portfolio for 1 year. But if you fast forward and you held it for 20 years, you would see a high of 18.6%, and an average of 11.6%, and a low of 6.4%. Point 4, consider how liquid you want your investments. Investments that are more liquid can convert to cash quickly. Stocks are a lot more liquid than real estate or businesses, which may take a while to sell. To best protect yourself, you should have a safety fund of 3 to 6 months of expenses. Point 5, account for inflation when investing. Inflation is consistent. At 2% inflation rate, your money in 10 years is negative 18%. In 15 years, it's negative 26%. 25 years, it's negative 39%. In 40 years, it's negative 55%. See, it's erosion of purchasing power. If you don't have your money in the market, the value of your money will decrease. Point 6, consider the tax consequences of your investments. Many people forget to do this, but for those sitting at higher tax brackets, then taxes may very well alter their decisions of what to actually invest in. Point 7, stock market returns versus inflation over a 200-year period, or more than the 200-year period. So since 1802, the U.S. stock market average annual return is 8.3%. Inflation has grown on average 1.4%. Therefore, stocks have beaten inflation by 6.9% per year since 1802. Point 8, large cap stocks retain their value better in downturn markets than small cap. So to quote the book, in 1937, small company stocks plummeted 58%, while S&P fell 35%. And in 1969 to 1970, small company stocks fell 38%, while S&P 500 fell just 5%. Moving on to point 9, and this is probably the most important point, if not in this book, at least in this chapter. Compounding returns make a huge difference. Compounding is reinvesting the interest you make in order to make more interest. For example, you invest $1,000 at 10% yield. After 1 year, you have $1,100. Then in year 2, it's $1,100 at 10%, which is $1,200 and $10. And by year 40, it would be over $45,000. Compounding is huge. Moving to chapter 3, the workings of the stock and bond markets. So the first point is, in order to raise money, large companies usually choose to issue stocks or bonds. A bond is when you lend a company money to be paid back with interest. Stock is when you make a purchase of a fraction of a company. You become an owner and make money if the company's value increases, but you can also lose money. Typically, companies are more likely to issue bonds if the stock market is depressed. But if the stock market's booming, then the new stocks can be sold at a premium price. So a lot of companies tend to do that. Moving to point 2, the value of a stock depends on the company's growth and profitability. Experts measure this in many forms. Very common is the price to earnings ratio, which is the value of a stock divided by the earnings. Point 3 is understanding efficient market theory. This is probably the most important point in chapter 3. It means that share prices already reflect current information and news. So if you see something on the New York Times or the Washington Post that you think is going to affect the market, well, according to efficient market theory, it would say that the market has already adjusted to that news. Moving on to point 4. Stock markets and bonds tend to be extremely efficient, meaning that the prices reflect the value. While real estate and businesses may not always be efficient, which allows for greater returns. Example of this is you have a homeowner who, let's say, his work gets transferred to a different state, or her work gets transferred to a different state. They have to sell their home and buy a new one, but in order to afford a new one, they have to sell their one first. So there's an urgency to sell their home, which may force the owner to lower the home's price under current market value, causing a distressed sell, which for us, the buyer, is huge because we could get a better return on our investment. Moving to point 5, interest rates, inflation, and Federal Reserve's monetary policies affect the economy and markets. So moving on to point 6, interest rates and inflation tend to increase or decrease together. Interest rates usually follow inflation when it increases, otherwise the purchasing power decreases. And point 7, the last point here, is keep track of what the Fed is up to. The Fed influences interest rates and controls the money circulation. The Federal Reserve is also known as a central bank. Well, this comes to conclusion for our book review here. I hope you enjoyed it. Leave notes in the comments of what books you want to see in the future, what you liked or what you disliked, and what you thought I could add. And thank you.